Welcome to the Professional Edge. My name's Todd, tax attorney, CPA, and certified financial planner. With everything going on in the market, we need to discuss what's happening with inflation. In our previous session, we were talking about inflation, and there's 8 things to cover. So let's think of an octopus. It's got 8 tentacles. So with this, we're going to review those tentacles. That way we can understand and think about all the considerations that we have to go forward. So the first tentacle we talked about was inflation adjustment, those interest rate sensitive investments that you have. We discussed bonds. So let's go to another interest rate sensitive, that second tentacle on the octopus, and that is preferred stocks. Those are stocks mainly in banks in the financial sector that pay out these dividends. Well, lo and behold, a lot of people got caught chasing yields. Well, lo and behold, we look at the yield and we have to calculate and say, wow, I'm getting 6% rate of return, but if the underlying investment is actually falling in value, then we have to calculate what our real net rate of return. And a lot of individuals will bring their statements into the Cunningham Center. We'll take a look at these, and I will ask a very candid question on this tentacle number 3 on the octopus. And it says, okay, you hold these preferred stocks. Why do you have those? And they say, well, I'm generating the income that I'm using. And I said, okay, make a note of that, whether they're using that income or not. That's an item for consideration. But when they come back, then I say, okay, and you're getting that 6% yield? Yep, And do you understand the real rate of return on that investment? They sort of look at me like deer in the headlights, and they say, no. And I say, okay, that's fine. Let me do an analysis on that, and I'll come back to you, and I'll show you this. And then when we meet again at the Cunningham Center down here in Columbus or up in Atlanta, if you want to challenge the traffic and all the road construction that we're having, it's unbelievable. But with that, we sat down and we showed them the actual real net rate of return. So they may have been getting that 6% and they think that that's their actual rate of return. But if the underlying value of that equity, that preferred stock, is actually falling in value, then we have to take that into consideration on your real rate of return. Then again, we also have to take into account whether you're actually spending those dollars, because we've seen clients come in, being a CPA and a tax attorney, you understand the tax consequence. And you, as a listener here on the Professional Edge, should be getting coordinated advice, tax advice from a licensed professional. A lot of stockbrokers, they have that little disclosure on your statement which says we are not authorized or legally licensed to give you tax advice. But let's think about that. Every financial decision you make entails taxes. So why wouldn't you be getting that coordinated counsel and advice from a licensed professional that integrates financial planning with tax planning? And that's what we do at Estate Management Counselors. So back to the preferreds and the income. They are having these income producing assets over here, and they're actually not taking any distributions from the account. And this is an after-tax account. So again, not the K1, but the 1099 comes out at the end of the year, and here's your income that you have to report on your tax return. And lo and behold, they're paying tax on money they're not spending. So that's faux pas number 1 on this tentacle on the octopus. Number 3, preferred stocks are interest rate sensitive. And if you are having these in the wrong account in your portfolio, you're paying tax on dollars you're not spending. That makes 0 financial sense. So this is an opportunity to say, okay, let's make an evaluation of this. I don't want to do the work. I understand everybody's hot. Everybody's busy. We're having record heat, record inflation, record adjustments from the Fed. What else can happen? Well, if you want us to do that analysis, come back to you and say, here's your adjustments that we would make. We can add value to what you're currently doing. Then you have the decision to make to whether engage our services or not. So to have that candid conversation, do give our office a call at 877-654-9798. That number again, 877-654-9798. And when you schedule that appointment, you know what? We're going to send you a bonus, and that is a hardbound book. It's called The Big Retirement Risk. So with that in mind, we have a couple things on that. It discusses that in detail. And that is part of this inflation that we're talking about. And we have number 3 tentacle on the octopus covered, and that is your interest rate sensitive equities. So let's go to number 4 tentacle on this octopus, and that is equities themselves. Well, with record inflation, we have to understand what's going to go on. And record inflation, then the consumer is actually spending more for the items of everyday living. That is food and gas. So when we have food and gas costing more, then the individual has less money to spend on discretionary spending. So what investments, what sector of the market is going to take a hit in the discretionary spending? Well, we got mortgage rates of 30-year mortgages jumped above 6% now with the Fed adjustment of the 75 basis points this past week. So guess what? That increased cost of that mortgage is now more than doubled from 18 months ago when we were in the 3s. So think about that for a second. Your mortgage payment on a 30-year mortgage has doubled. Well, guess what? That will slow the housing market down, because if I have to pay double for the same house I thought I could get 18 months ago, I'm going to probably scratch my head and say, you know what? It's not time to actually change houses. So a lot of that is going to be tempered. So the downfall of that is going to be these other sectors are going to become affected as well. So let's think about that for a second. A lot of individuals are going to second think about changing houses or even building a new house. So if we just temper that demand, again, the Fed has to raise these rates to, quote, decrease demand. So if the cost of borrowing increases, then the demand for housing or that 30-year mortgage will subside. That's the theory in macroeconomics. And yes, it is painful because now that price of that home is going to fall, so the potential buyer, can actually afford that house. And therefore, there's less housing demand. And if there's less demand, then the prices will come down. That's the macroeconomic theory that we're all going to experience. And yes, it is real. It's going to be coming forth. So we have this big this big inflation, 40 years level. And with that comes a very pointed demand or a very pointed change by the Fed, and that is the raise of 50 basis points and now a 75 basis point. They're leading a clear direction, but yet it's a little bit disjoint from the market and what they have been, quote, being clear in their understanding or their direction to us as a general population. So that's a topic for a different discussion, but we are on the tentacles of the octopus on number 4 for the equity side. So when we look at this, what equities are going to be affected by this decrease in demand that the Fed is forcing upon us? Well, we got the housing sector. So should you buy home builder stock or be there, or should you be in commodities such as lumber, such as wire? Well, those are things for a private conversation that we can have at the Cunningham Center. And to sit down and have that complimentary consultation, do give our office a call at 877-654-9798. That number again, 877-654-9798. So again, you can't sit here like a deer in the headlights and make no adjustment on your portfolio. We've already seen on one of the tentacles on the octopus that you have bonds. As the interest rates rise, bond values fall. The farther duration you have from the fulcrum of a zero duration, that's basically cash, that you are going to be more interest rate sensitive. So again, when have you had a candid conversation with a licensed professional about the duration of your bond portfolio and understand what your interest rate risk is? And again, what equities are you having? Don't just sit there, because technology is off substantially this year to date. It's one of the hardest hit sectors that we have going forward. Equity prices are down about 25%. Bond prices are down about 11%. And when we look at crypto, we have to really step back because Bitcoin, if you can imagine this, has lost over 25% of its value since last Friday. Yes, 25% since last Friday. And Ether has actually lost a third of its value. So this crypto craze is under significant pressure. So we have to understand what's going on there too. If you're a crypto investor, then you need to be heeding a warning that the Fed is putting forth with these interest rate adjustments. And you're saying, okay, how does that correlate? Well, let's sit down and have a conversation. I'll share with you how it correlates. So when we look at this, we're on the tentacle of that octopus. We're on number 4. So let's switch to number 5. Being a tax attorney and a CPA, we have to understand the tax consequences of what we're doing. Yes, things have fallen in value. Don't get stymied. Yes, that's the reality of investing. There is risk to investing. We've sort of been spoiled over the past decade with this easy monetary policy of the Fed. They have been a net purchaser of these bonds in the market. We discussed that, and they were buying $120 billion a month of these bonds. So they were increasing the money supply. And again, when there's too much money run around for a limited number of goods, guess what? We're going to have the price increases. And that's exactly, if you look at the housing market, about 6 months ago, you were seeing above ask offers, multiple offers. Well, you know what? The supply of housing or quality housing had diminished significantly. So you had all these dollars chasing a limited supply of housing. Guess what? That bids up the price. That's inflation 101 to relate that to. So when we look at this, tentacle number 5 on the octopus is harvest your tax losses. It's okay if things go down in value. Let's switch. Let's move the portfolio, reallocate that portfolio to the proper sectors to weather this inflation adjustment environment. It's different. We haven't seen this in 40 years, folks. So again, it's not the same of set and forget. And one of the quotes I read was, it's easy to hold the tiller in calm seas. Well, the past 10 years have been calm seas, except for COVID. That was fine. That was a blink of an eye. Most people don't realize that the month of March, equities markets cratered by 30%, then recovered. So do you have an emotional response? And that's another tentacle on this octopus that we're going to cover. So when we look at this, what exactly are we going to do to harvest these tax losses? Yes, we understand in an IRA, you sell your investments, you can't capture that tax loss and put it on your tax return. Being a CPA, completely understand that. So if there's some tax losses within your brokerage account, your after-tax brokerage account, it's okay to sell those investments, but let's not park it entirely in cash. Let's move over to a different sector that is going to benefit from these interest rate adjustments. So again, if you're not sure what to do, how to do it, give our office a call at 877-654-9798. That number again, 877-654-9798. I appreciate you listening to The Professional Edge. My name's Todd, tax attorney, CPA, and certified financial planner. More coming up here on The Professional Edge.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Seen Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Seen is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Seen Todd to learn how you can benefit from their multidisciplinary practice where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach Estate Management Counselors and speak with Seen Todd by calling 1-877-654-9798. That's 1-877-654-9798.